right. Good morning, good evening, everyone. I hope you're doing well, and I also hope that you can hear me clearly. Okay, that's very good. Thanks for the confirmation. So we're going to start the class today, but before that, I have a quick announcement. It's regarding Sunday. Actually, I told you at some point that we may have class on Sunday, and actually, we will not have class on Sunday. Okay, so no class on Sunday. So it's gonna be just like I said at the very first lecture, or regular teaching schedule, right? So of course, every day this week up until Saturday, then there's gonna be a break on Sunday, then we resume teaching on Monday and Tuesday. Okay. All right. So before we go back to the exercise which I explained yesterday, and to which I'm going to give you the answers in a moment. I would like, as every day, I think it's a good hygiene to do that, is to make a quick summary of yesterday's class, right? Um, so you also have I've uploaded yesterday's shared notes. So hopefully you were able to download them from the Canvas platform, which works pretty well. Um, so, what did we do yesterday? All right. So we talked mostly about monetary policy. Okay, and in particular, we started by explaining why do we need monetary policy. Okay. Okay. So in general terms, monetary policy is about controlling the amount of money in the economy in order to keep inflation under control, right? And by that, usually we mean between 0 and 3%. Okay. Why? We know that deflation is bad. Okay. No, nobody wants to target deflation. There are too many risks associated, in particular in terms of postponing expense. Okay. So that's what monetary policy is. So, but why do we need monetary policy? Well, we need monetary policy uh, because banks may create too much money, which would translate into too high inflation, right? And the next question is, all right, sir, thank you very much for this. I know that already, but why is inflation bad then? There are two sets of reasons, right? Number one, there is no positive correlation between inflation and real GDP growth, right? So, and in addition, very high level of inflation are associated with crumbling economies, see Venezuela, for instance, right? So that's the first reason. There is no positive relationship between inflation and GDP, real GDP per capita growth. Okay, we know that prosperity, wealth, high incomes countries, those are not countries that are running very high inflation rates, right? Those are not countries that are printing a lot of money. Those are countries that are in which the labor force is productive. And you know that from Economics 101 from your economic growth classes. It's this labor productivity is due to the stock of capital per worker, whether it's physical or human, and the level of technological knowledge. Okay, nothing to do with inflation. All right. And the second set of reason is related to what we call the costs of inflation. Right. I'm not going to come back on them, but you have like the menu cost, the shoe liter cost, the inflation tax, uh, poor allocation of resources because agents cannot make good informed decisions between because prices keep changing all the time, right? So it's very hard to make a good economic decision in this environment, right? What else did we have? We had the wealth redistribution as well. Wealth redistribution, in which well, pretty much high inflation benefits people that are indebted and harms people that are lending money. And finally, we had the inflation tax, right? The fact that people carry less cash around when there's inflation, and therefore there's less spending, and therefore lower GDP. All right, so those are pretty much the the, uh, the environment in which we're working with. We need monetary policy to make sure that there is not too much um, money being created, because too much money being created translates usually into higher inflation. I've shown you some statistics about that. Remember graph number 1 yesterday from Mike Kendless and Weber. And therefore, we need monetary policy in the sense that we need some institution. Monetary policy is conducted by the central bank, right? And the central bank. That's what it is. Okay. How does it work briefly? Because we did that yesterday. How does it work? Okay. The important thing to realize is that commercial banks need money in their day-to-day activities. All right. So the reason. Oh, I guess I'm gonna. No, I've asked that question yesterday. So, but it's role. Interbank payments and reserve requirements. Okay. And the important thing, and I'm going to put that in capital later, the more as a commercial bank, the more money you lend, the larger the deposits on your liability side, the higher the need for base money. Problem, this money is not free. It's costly actually. Okay, you need to pay interest to access this money. Therefore, central bank's job is to increase cost of base money in order to increase the amount of money being created. All right, that's how it works. So the central bank can act on cost of base money. That's what policy rate or the volume of base money needed. And typically that plays via the reserve requirement, right? I think I told you in the West, costly one in China, costly two. So interesting differences here. What are the monetary policy tools? With regards to one, we have two things. We have the discount rate, 1.1 discount rate, the discount window, which is about borrowing base money directly from the central bank. And second, we have open market operations on the interbank market. Bank. Okay. And the third tool, which is reserve requirement ratio. Right? How about reserve requirement ratio? Okay, I'm gonna save us some time. All right, that's pretty much where we were yesterday. All right, so before I move to the exercise, I'm happy to take a couple of questions here in case there is something you want me to clarify. We'll move on. All right, I don't see anyone typing, so it looks like it's all clear. So we're going to move towards answering the questions from the exercise, okay? So we have a central bank and a representative commercial uh, bank. I can see someone is typing, so maybe I'm going to wait for that question. The money multiplier function you introduced at the end of the previous session and in session one was different. With these two formulas, I see what you mean. Yeah. Let me put it this way. There are two ways you can look at the money multiplier. The first one is looking at the general idea behind this money multiplier. And the general idea is the following. Given the amount of base money that I have, how much private money can I create as a commercial bank? Or if you take the entire economy, given the amount of base money available in the economy, how much deposits, how much private money commercial banks can create. Okay, that's the general idea. So that's what I meant yesterday by writing M1 by M0. And I guess that's one of the formula that you are referring to in your question. Okay. And then earlier on, I referred to another formula in which I said that the money multiplier is pretty much 1 divided by the reserve requirement ratio, right? And to answer your question, so the second one would be like a bit more specific, but the second one is actually not exactly true, right? If you look at, for instance, the manual that I've recommended from Mishkin, he's going to provide the exact formula. It's a little bit more involved. I'm not asking you to know that formula because what I'm asking you to do is to understand what this idea of money multiplier means exactly. Okay, feel free to know exactly the formula, but what I want you to do is understand what is it about, and it's about linking base money and private money. That's what it is. Okay, so to answer your question, they will not give the same result. And should I ask any question regarding this at the exam, I will be very clear to make sure that there is no ambiguity for you. Okay. Okay, sir. All right. So let's do this exercise. So we have this the central bank and a representative commercial bank with the following balance sheet. So we looked at them yesterday already. As you can see, um, Now we still have the reserves for the commercial bank, the loans, and now I've introduced a new item, which is securities. And we will see later today, I'm going to show you some real commercial balance sheets. And as you will see, the main items are exactly this. The rest is just detail, right? So this looks like a very realistic commercial bank balance sheet. And obviously, on the liability side, we have well, the corresponding amount in terms of deposit. For central bank, I talked to you about that yesterday before the end of the class. A central bank's balance sheet is actually much simpler in a following sense. That the two big items are on the asset side, you have the securities that were bought by the central bank. And how did the central bank buy those securities? Well, just by issuing base money, right? So that's a wonderful thing to do, issuing your own money to buy securities. If we want to be a little bit more specific here, and which we can decompose base money in its two main components. And actually, I'm going to ask you this. This is going to be a question that I'm asking you. What are the two components of base money? Of N0, pretty much. They will both show up on the liability side of the central bank's balance sheet. So I want this to be very clear. I can see you guys are typing, so I'm waiting for the answers to show up. Deposits by commercial bank and business. Exactly. Very, very good. That's exactly. So I'm going to write that stuff here. So for instance, we're going to have cash. I'm going to call it cash, right? That's the bit. Perhaps we have, I don't know, 300K, right? And then we have deposits by central bank, perhaps 700K, okay? And if you add those two, then it adds up to 1 million, okay? So that's the way it works, all right? So I'm going to clear that up. No, I'm not going to clear that up. Yes, I do. I will. Hop. Move back to the exercise. I assume the central bank conducts some open market operation, expanding the money supply by 15,000 US dollar, all of which benefiting our representative commercial bank. Question number one, represent the central bank and the representative commercial bank balance sheets after the open market operation. Okay, so how does it work here? So we're going to have the central bank that is actually going to buy securities from um, the uh, the commercial bank. So that means the securities. That's the first thing we can do. Right? We're going to have minus 15K. Lower cap minus 15K, right? And therefore, but the central bank is buying. So if we look at the security side now of the central bank, that means oops plus 15K, right? And how is the central bank going to buy those 15K? It's just gonna print its own money. I told you it's a great job being a banker. It's even better being a central banker. Talking here, okay. 15K plus 15K. All right, and this base money is going to end up right there, okay, on the reserve side of the commercial bank. So we have plus 15 plus 15. All right. If we do the new total now, and I'm gonna do this now. So we have. I'm gonna draw a line. I'm gonna cross that out because that's no longer true. and a bit of a line here, up like, like this. And if you, so that means we have 45, no, sorry, 55K in terms of reserves. And now in terms of securities for the commercial banks, we just have 85K. All right. And for our central bank, we have 1.015 million. Same here, 1.015 million. Here, clearly 1.015 MLN, 1.015 MLN. Okay, so let's check. So represent the central bank. All right. So a couple of comments here. Oh, first of all, perhaps is it okay for you? Question. Something you think, well, that sounds strange. I wouldn't have done that. How about doing this, sir? Do you think we could do that instead? I'm happy to look at what are your suggestions here or comments. It's very clear. Thank you. Thank you. So someone else is typing. I'm waiting for the question to show up. It's okay. I'm going to comment on all this, don't worry. There's someone else typing. Perhaps you can see that as well. Okay, well, there's nothing showing up, so yes. Why securities minus 15K? Remember the exercise, right? The so the idea. So if we go back to the central, assume the central bank conducts some open market operation, expanding the money supply by 15,000. Okay, so that means that the idea is that the central bank will buy securities from the commercial bank in exchange for base money, right? The idea is to add money to the economy, is to add base money. Because if you add base money to the economy, as we discussed yesterday, there are going to be two effects, right? The first effect is to make the interest rate drop on that particular interbank market. Do you remember yesterday we talked about that? And the second effect, it's going to provide more liquidity to the bank. And therefore, if you use the money multiplier now, if you look at this commercial bank, because it has more reserve, it can make more loans, right? So that's why you have this minus 15K, because the central bank is buying the securities from the commercial bank, and these securities now lends into the central bank's balance sheet. So it's been moved from the commercial bank's balance sheet to the central bank's balance sheet. So that's why we have the minus 15K here and the plus 15K here. Okay, it's because the central bank is buying those securities from the commercial bank. So they have to exit, they have to be removed from the commercial bank's balance sheet, right? And in exchange, what does the commercial bank get? Well, in exchange, it gets base money, right? It's right there. And where does this base money coming from? It's coming from the base money that has been created by the central bank, right? Yes, central bank, they can do this sort of stuff. They can print their own money to buy securities for themselves. Commercial banks cannot do that, right? Commercial bank, they cannot create money for themselves. They can create money for someone else, for the customers, for loans and buying foreign currencies, pretty much. Okay, so do you understand why it's minus 15 now? Okay, good. All right, so something else I want to highlight is the fact that the balance sheet of the commercial bank hasn't changed, right? It hasn't expanded. It's just a substitution, right? It's less securities and more reserves. Okay, so that's why the grand total for the commercial banks assets and liabilities hasn't changed. It's just a shift in the composition of the asset side of the commercial bank. Okay. However, if you look at the central bank, the total has increased, right? The central bank has expanded its balance sheet by creating money. Okay. And it used that newly created base money um, to buy securities from uh, the central bank. All right. So if we want to be very rigorous here, we would have to say that it's actually the commercial bank's account or deposit, right, that increased. Okay. Typically, um, central bank will buy by using the account at the central bank, not with cash. Okay. So that's question one. Question number two, what are the implications for one, the interest rate, two, the money multiplier, so the money multiplier, and three, the commercial bank's profitability. Okay. I think I'm gonna go back to shared notes. Okay. I'm gonna draw a line, and I'm gonna say so. That's exercise for question two. So for the interest rate, well, it is going to go down, right? Because by buying bonds, the price of bonds goes up, and therefore the rate of return of bonds goes down. And the rate of that return, the rate of return of bond is the interest rate, right? In this market. Interest rate on this market. Remember, I'm going to send you back to what we did yesterday. Yes, remember, we had this 1,000 bond example. Okay, so if you buy bonds, the price of bonds goes up, therefore the rate of return on this bond goes down. Therefore, and that's important, perhaps I didn't mention that yesterday, but if you want to issue new bonds, well, you have to align yourself on this new interest rate, right? You cannot offer a lower interest rate for the same level of risk, right? And okay, so the interest rate is going to go down. Okay, there's more money. There's more money. The price of money, another way of saying it, so the price of money, it's precisely the interest rate, right? That's what it is. You want money now rather than tomorrow, you go to a bank and you borrow money and they make you pay for that. And that's interest rate. The interest rate, another definition of the interest rate is the following. It's the price of having money now rather than tomorrow. Okay, that's one way of saying it. So the interest rate is going to go down. That's the point of this HOMO operation, right? Decrease the cost of liquidity, and by that I mean base money. Okay. here, remember, I'm speaking in relatively general terms. We later on in this class, we're going to look a bit more into the details of what sort of operation commercial banks use exactly. Typically, they use some sort of repo and this sort of stuff. But I want you to understand the general idea. It's all about adding or removing liquidity from the interbank market in order to raise or decrease the interest rate. Okay. With regards to the money multiplier, which we're going to look at, which we're going to define this way, okay? It's M1 divided by M0. Let's look at what we did. So if we look at M1, it hasn't changed, right? I'm gonna clear this. If you look at M1, M1 is here. M1 is unchanged. However, the reserved, or maybe I shouldn't have cleared it. Can I go back? No, I cannot. The reserves have increased, right? Remember, we had plus 15K here, okay? So this is unchanged, and this has gone up, okay? So the M1 divided by M0 ratio has fallen. The money multiplier has fallen in this example, okay? But it's intuitively you can understand why. The money multiplier is a ratio of private money divided by base money. But there's no more private money. There might be down the road, by the way. That's we're going to come back on this. But right now, at this very moment, M1 hasn't changed. However, M0 has increased because the central bank has injected $15,000 in terms of base money. Therefore, the M1 divided by M0 ratio has fallen. But what we can add is that later down the road, because the commercial bank has more base money, more loans. So it is likely that one will increase in the future. Okay. But at this, at right after this open market operation, the money multiplier defined by M1 divided by 0, M0 has fallen. Okay. And last point, we're looking at the commercial bank's profitability. Profitability. There are various ways of public chat. Let me see. What is all right? You need to look, click on share notes. Okay. So that you have, there are two ways I can communicate with you, either through the public chat or through shared notes. Okay, it should be on the top left of your screen. Okay. Interesting question. What is the relation between interest rate and bond with interest? So the rate of return, the interest rate on bonds is equal to the opportunity cost of base money. That's very important. Okay. So Mrs. Who asked regarding my typing, were you able to access share notes? Are you offline? Okay. So it's an opportunity cost. You know, remember what an opportunity cost is. opportunity cost means uh, what of action of, let's say, of doing action A equal to what you forego by doing A instead of B, C, or D, etc. Okay, an opportunity cost is pretty much yeah, what you forego, what you give up when you decide to do something. Okay, for instance, um, if you decide to, um, I don't know, you on Sunday you decide to go to the beach, where you forego spending time with in resting in your bed, for instance, or watching TV. So here, the opportunity cost of that's what the interest rate on this market is. If you're holding a bond, if you buy a bond, you will get an interest on this bond. Okay? But if you hold base money instead of the bond, then you will not get this rate of return. Okay, that's why the interest rate on the interbank market can be seen as the opportunity cost of base money. That is why uh, we say that the cost of base money is the interest rate. Okay. We're going to come back on this later on when we look at repos and so on, in which it's perhaps a bit clearer because the cost of the operation is embedded directly. The central bank buys some of those bonds and gives you a little bit less back, right? So that's the difference being the cost, right? That's what I've just said is another way of looking at it, and I think it's perhaps clearer at this stage. All right. So I'm going to move back to share notes. I want to answer that profitability question, right? Central bank's profitability. So I would say because commercial banks have less securities which earn an income either in the form of interest or dividends, and more base money, which is nothing, then the immediate effect on profitability is negative. Obviously, right? You have less income paying interest. Remember, the securities went down, this went down, and the reserve money went up. Right? This pays interest. Okay, this doesn't. Okay, reserve don't. For that reason, um, we can say that at least at the by the when this OMO operation is conducted, the bank's profitability is going to fall. But that's the short-term answer, right? But in the long run, again, that's what in the long run, base money means a greater ability to make loans and therefore to earn in interest income, right? So you have to distinguish, I would say, between the short term and the long run, right? All right. Is that clear for everyone here? Back. Any question? A comment or suggestion? Very clear. Thank you. All right. So question number 3 now. What are the differences do you see between the way commercial banks create money and the way central banks create money. Well, this is pretty important. As I said, commercial bank they can create money on two occasions. They can create money by monetizing foreign currencies, and they can create money by making loans to their customers. But they cannot create money to buy securities from themselves. Okay? So perhaps I'm going to write that stuff into share notes. Question 3. All right. Um, Commercial banks cannot create money to buy securities for themselves. Central banks can. Okay, it just did. Okay. So that's one difference. Another difference. I have a question. Let me go back. J'ai compris. Very good. Um, Another difference, and I think it's pretty essential, is the fact that commercial banks are limited in their in the money they can create because of the reserve ratio requirement. Okay, so they have to hold some sort of reserve asset, which nowadays is money, right? So they are constrained, right? They are constrained because if the central bank um, increases either or both the interest rate and the RRR, then the commercial bank will probably decrease, stop creating money. But for a central bank, and I can see there's a question or comment in the chat. I'm going to answer that in a moment. For a central bank, there is no regulation preventing it from creating too much base money, right? Another way of saying it is there is no reserve ratio requirement for central bank, right? So, and that is what we observe in the West since 2008, right? Massive amounts of base money being created and injected into the US and the European banking system. By the way, Japan exactly the same. Right. The 1990s and 2000. All right. But this is really key. I mean, you must. This is very important to understand, right? Both commercial banks and central banks have the ability to create money, but commercial banks have a very specific legal framework that says, well, there are two instances in which you can do that. You can buy securities or you can make loans. There's pretty much no regulation like this for central bank. They can do whatever they want. They can buy securities. They can make loans as well to the government, for instance. And also they can buy foreign exchange currencies. So, but importantly, there is no one, there is no one, there is no regulation that says, well, your central bank, there's only so much money you can create. Okay, In a sense, it's related to its function of lender in last resort, which we're going to talk about in a moment. So I'm going to go back to the public chat and see what are the questions. Central bank doesn't face limit. Exactly. That's very true. I think too much money from the America can lead to inflation. You're very right. You are very right. And this can be a problem. Okay, and because if the central bank creates too much money, just like in Zimbabwe, for instance, or in Venezuela, I have an exercise on this for later today. This can be highly inflationary, but at this stage, or we're gonna come back on this point, but at this stage, I want you to understand that there's a difference in nature. There is some sort of framework, legal framework, uh, within which commercial banks can or cannot create money. For central banks, it's really up in the air. It's really up depending on how serious these people are. Right? So in serious countries, in Vietnam, in China, in the West, etc., central banks tend to be relatively careful. They don't want to go too far. Although, in my opinion, what's going on in US and in Europe at the moment is too far. But in some other country in which perhaps the government are not that serious, like Zimbabwe or whatever, then the central bank can really become crazy. And the next thing you know, you end up with a double-digit monthly inflation, right? So this is very true. So I don't want to talk too much about that because we're going to come back on it. So is there any question on this exercise before we move on? No, sir. All right, so I guess we can proceed. All right, so solution in class. I can see that someone is typing, so I'm going to wait for the question to show up. Could central bank make a loan for government? Yeah, technically they can. And again, I have an exercise precisely on this question that I'm going to ask you to do later today. So technically they can. It's just about expanding the liability side and the asset side, no problem. However, some governments have decided that it's too dangerous. Right? For instance, in France and in Europe, this ability was removed in most European countries throughout the 1980s. Why? Because precisely as one of your fellow students said, this can lead to high inflation. Because if you give too much money to the government without asking it to pay back, because obviously that's usually the way it works, and the government can spend too much money, pay its civil servants too much, and so on and so on. So technically, it's possible, but in many countries, this possibility has been removed from governments. But in many countries, it hasn't been removed. It doesn't mean it will immediately translate into hyperinflation. It depends on how reasonable the government and the central bank are. Okay. I can see there are some other questions coming, so I'm waiting for them. You're very welcome. In the case, the US sells bonds to China. Yes, that's different in the following sense. It doesn't involve central banks. You see, here typically we're talking about treasury bonds issued by the US government. Maybe 10-year bonds, 20-year bonds, whatever. And those bonds are bought by Chinese banks, investment firms, etc. So I think it doesn't involve central banks, right? So I don't think it's impacting the money supply. It's not really related, sorry, to this exercise. It's from a macroeconomic point of view, it's extremely important. Right, there's a lot of saving of Chinese savings being invested in U.S. government bonds, and this can be a big problem down the road for the U.S. because they're pretty much spending too much money compared to their income, and the Chinese are lending them. So I'm not saying it's not important. It's very important. It has some big macroeconomic repercussions, but for our purpose at the moment, I don't think it's directly related. Okay. There's another question coming up apparently. What if the borrower cannot pay back the loan to commercial bank? So will commercial bank go bankrupt? And how is the deposit money from other clients? The money is deposited by other clients, cannot disappear by that way, right? It can. I can see someone is worried. That's good. You're starting to understand how these whole things work. It's fine. I mean, it's been working like this for a very long time, and as long as people are not worried or do not panic, it can go on for a very long time. But you're right. I mean, if there's only 3% of the deposit that are covered by base money, that might be a problem. One option would be that the central bank prints a lot of money, and so that and it provided to the commercial bank so that everyone can withdraw. Regarding your first question, we in the section 3 of this class, when we talk about the financial crisis, I'm going to come back on this. Okay, but you're right. If the borrower does not pay back, if many borrowers do not pay back, then the bank goes bust. And we're gonna look at. I think we did that a little bit, perhaps 2 days ago. Um, it's going to impact the central bank's balance sheet, obviously, and it's going to decrease its equity. And if the equity becomes negative, then the bank is in trouble. So, to answer your question, what if the borrower cannot pay back the loan? If it's just one loan, that's okay. The bank can manage. If it's a few loans, it's normal. There's always clients that are not able to pay back. It can become a problem when there are many clients that cannot pay back the loan. Okay, and then there is a risk for the commercial bank to go bust. In which case, it's going to be difficult for the other people to withdraw their money. We're going to come back on this later. So I have not an exercise, but a couple of slides on it. Okay, so I think I'm going to move forward. So now that we're done with this exercise 4, I want to show you some statistics about the US. So that's the money stock in the USA. And by money stock, I mean M1. Remember, M1 is uh, coins and bills. Plus demand deposits by household and businesses at commercial. That's the money stock. As you can see, it was growing relatively steadily, right? There's a bit of a bump here, and then relatively steadily, and then starting uh, around the financial crisis, it went straight up, right? So big increase in M1. If we look at M0, it's even more spectacular. So M0 is the monetary base, so you know what that is now. So that's bills and deposit by commercial banks at the central bank. It's even more spectacular because it was growing very smoothly, right? Very smoothly up until the financial crisis, right there. Then we had a big spike in the creation of M0. What does this correspond to? When you may remember what happened, right? You had a few uh, big banks in the US that were in big trouble because they were losing so much money on the housing market in the US. So the Federal Reserve Bank had to inject a lot of money in the system, in the banking system, in the bank's balance sheet, on their asset side. So here, a lot of additional reserve to make sure that the banks were able to make their to participate to the interbank market, right? And then they carry on with QE. Do you remember this QE stuff? Quantitative easing. I'm sure you heard about that. Quantitative easing, which was pretty much about adding money, and they called it QE, right? And uh, this is QE1, QE2, and QE3, right? We're going to come back on this in section 3 regarding the financial crisis. So we've seen M1, we've seen M2. Now this is the ratio of M1 divided by M2. So that's the money multiplier that I was talking about, right? As you can see, so M1 was increasing, but M2 was increasing, but M0 was increasing faster. Okay, so what this is, we're talking about 86, right? So, and then you have this massive liquidity injection. So the funny thing is that you had a ratio. Look at that. It was around 3, and it's been falling steadily, right? But it was still above 1, and then bang, starting after 2008, it was below 1. That's amazing, right? That means, I mean, think about it for a minute. That means in the US banking, in the US economy, the M0 is greater than M1. That's what it means. That tells you something about the massive amount of base money that's been printed by the Federal Reserve. It's so big that it's bigger now than M1. And remember that in M1 you have all the deposits created by private commercial banks, and that's a lot of money, right? So that tells you something about how troubled the situation is, in a sense, right? We're going to come back on this in section 3 on the financial crisis. All right, so that's for open market operations. So, because by the way, those QE right there, it was all about buying bonds. Not exactly bonds, actually. Many of that were buying what we called mortgage-backed securities. Securities, called MBS, right? I'm going to explain exactly what that means probably tomorrow, but those were pretty much securities that were related to the housing market. Okay, doing well when the housing market was doing well, and doing poorly when the housing market was doing poorly. And QE, whether it's QE1, quantitative easing 1, quantitative easing 2, or quantitative easing 3, was especially the 1, and this guy as well here, although was not quantitative easing, was all about buying some of those MBS from the commercial banks. Uh, so that's why it's related to OMO, right? Open market operations. So we are in the process of looking at the tools of monetary policy. So the second one, I told you, remember if we look back at shared notes, the tools of monetary policy, right? Yeah. Okay. We've done the open market operations. Okay. Now I want to briefly talk about the discount rate, the discount window. It's much easier, so I'm going to go faster. The discount rate, private banks can borrow money directly from the central bank. They're not going through the interbank market. Okay? And that's very easy to understand then. A higher discount rate makes it more expensive for private banks to borrow reserves by the central bank and vice versa. And as I said yesterday, many countries, they are too small to have an interbank market. Yes, I'm sure some of you have done some economics classes. Maybe some of you have not, but there's something that we emphasize in economics is the fact that for a market to work properly, we need to have many buyers, and we need to have many suppliers, right? If we have many buyers and many suppliers, then prices move smoothly, and there is no big spike in the prices or in the quantities being traded. So that's true also for the money market. So in a small countries where you would have maybe, I don't know, two banks or three banks, there's no way you can organize an interbank market because every bank is going to have too much market power. So the money is going to be the market's going to be highly volatile, right? So you don't want that. So that's why in small countries, typically there is no interbank market. The only option for commercial banks uh, is to borrow money directly from the central bank. Okay, that's the discount. In New Zealand, for instance, that's the case. New Zealand, when in Vietnam, you have a you have an interbank market in the West, obviously. Okay, so those are those short-term interest rate, right? That you have at the discount window. I thought I should give you some data because I mean, look at that. This is amazing, right? Since 2008, this price has been killed, right? The interest rate in the West, in the Western world, and Japan. So Japan is in red, Germany is in green, the United Kingdom is in blue, and the black one is the USA. In green is Germany, and then later the Eurozone. As you can see, those interest rates were much higher. Okay, then for quite a bit of time, let's say the second half, I'm going to use a different color. The second half of the 90s up to the second half of the 2000 was pretty much normal level, I would say, in the West. Not in Japan, it was already way down. And then they all crashed to zero because of the great financial crisis that started in 2008. Okay, so we're going to come back on that. Um, but that tells you, this tells you, I'm going to write that here. This tells you how expensive this money is at the moment for for commercial bank. It is actually it is very cheap, not free, and in some cases, look at the eurozone since 2016. It, base money is actually subsidized by the central bank. Yes, yes, because discount rate, interest rate, interest rate, policy rate is negative. That's what it means. When you have a negative interest rate, it means you borrow $100 and you just have to pay back 99. Okay, that's what a negative interest rate is. So in Europe at the moment, the central bank is subsidizing commercial banks in the following sense. They are charging a negative interest rate. All right. So that's amazing. This is really new. Uh, and if you ask me, this is really bad. Okay. There is a reason why we had a positive interest rate for thousands of years, right? There must be some reason, right? I don't think we have discovered the formula for happiness since 2016 by crushing interest rates into negative territory. There must be something wrong here. We're going to come back on that. Right. Mm, perhaps we could. Let me see. Yes, reserve requirement. So that's the last monetary policy tool. We talked about it quite extensively already, so I'm not going to spend too much time. That's this guy here, reserve ratio requirement. All right. So I'm just going to read this slide. We've talked about it already. The reserve ratio is a central bank regulation that sets the amount of funds that a depository institution must hold in reserve against specific deposit liabilities, typically deposit. The central bank can try to decrease the money supply by increasing the reserve ratio and vice versa. Reserves resemble interest-free loans to the central bank and therefore negatively affect banks' profit. Western central banks tend not to change the reserve ratio requirement in contrast to the People's Bank of China, which uses it as a monetary policy instrument. Okay. Yes, that's something that we need to discuss a little bit. Competition between banks is a key element of monetary policy transmission. What do we mean by that? Transmission, which means how the central bank transmit this decision to the commercial banks. How are commercial banks impacted by the decision by the central bank? So I want to talk a little bit about this. Key monetary policy channels. When the interest rate increases, private banks have no choice but to pass on this higher cost to their customers, borrowers, if they want to maintain their profit. Yes, it's important to understand this. Perhaps I'm going to move to the blank, um, the blank, the blank slide. So suppose you have the following. You have the policy rate that is equal to 3%. And assume that the commercial bank 10-year loan rate is equal to, I don't know, 8%. Somehow it tells you that the gross, the net return on lending money for this bank is 8% minus 3% is 5%. See what I'm doing here? I'm saying, okay, assume you're a customer, you walk into a bank, you borrow money for 10-year period. Okay. And bank says, okay, that's fine. That's the interest rate you're gonna have to pay. Because you're creating money as a commercial bank, you're gonna need base money, more base money. Okay, not for the exact amount of the loan, obviously, but for some of it. So that's the interest rate you're going to pay on that base money. So there is a sense in which the profit margin, you can say that, the interest margin, perhaps we could say that, the interest rate margin, the difference between the interest rate that you charge is equal to the difference between the rate that you charge as a commercial bank to your customers and the interest rate, which is the policy rate, slash policy rate that you pay to the. My point is the following. The policy rate goes up as a commercial bank. If you want to maintain your profit margin, and you must raise the interest rate you charge, right, to your customers. For instance, the policy rate increases to 4%, and you will probably 8% net. This is not as simple as this, obviously, because there are a lot of other charges for the commercial bank, like first of all, the salaries being paid to the staff, which is huge. And second, this policy rate applies only to a fraction of the loan and so on. But still, there's some sense that when the policy rate goes up, the whole banking activity cost goes up. So you need to pass on these costs. Okay, that's what I mean by that. Okay, so I'm gonna move back to the main presentation just to illustrate this point, right? Um, when interest rate increases, private banks have no choice but to pass on this higher cost. You see, because they need to keep their profit margin. So if their refinancing costs go up, they will increase the interest rate they charge to the customer. And similarly, or conversely, when the interest rate drops, banks have no choice but to pass on the decrease to the customers thanks to competitive pressure. Yes, we can go back to the blank slides here. You see, if rather than going up, the policy rate goes down to 2%, if the policy rate is 2%, now the net gain is 8% minus 2% equals 6%. So as a bank, you may think, well, that's good. Thanks to this lower policy rate, I'm making more profits on the loans that I'm making because I'm going to keep the interest rate that I'm charging to my customer constant. What I'm saying is that it's not going to happen this way because of competition. There's always a bank that will have an incentive to decrease the interest rate that it charges to its customers. Why? Because now it's cheaper. Base money is cheaper, so their costs have fallen. So they can decrease the interest rate they charge to their customers and still keep their profit margin constant. You see? So that's why I was saying um, that competition will actually ensure that changes in the policy rate are passed on to the customer. Okay, so this is really important here to understand how monetary policy works. Because you could say, okay, the central bank changes interest rate. Why should I care? As a bank, you will care because if the interest rate goes up, your cost will go up, and therefore, if you want to keep your profit, you need to raise the interest rate that you charge to customers. No question about that. And on the other side, if the central bank decreases the policy rate, you may think, well, my profit margin has increased. Yes, it may, but some banks will say, I'm going to pass on this lower cost immediately in order maybe to attract customers from other banks if they don't decrease their own interest rates. So most banks will make the same reasoning, and that's why when the policy rate goes down, typically uh, the rates charged by commercial banks will go down as well. Okay, this is a key element of monetary policy transmission. That's the important word here, transmission. How this is being transmitted. Okay, so let me see because I want to make a quick break before the exercise. Where is the exercise? Bit further. So I think we're gonna make a quick break now. Okay, 5 minute break to grab a cup of coffee, a cup of tea, and when we come back, we're gonna reconvene and then do an exercise. Okay, so 5 minutes break. Okay, welcome back, everyone. Um, let's move on. Do you have any question on this monetary policy transmission? I think it's really essential to understand that you need some sort of market competition between banks to make sure that those monetary policy decisions are passed on smoothly to the customers, right? For instance, when I lived in Australia, there are only four banks. So there was always some suspicion that they were acting as an oligopoly and not really passing on monetary policy decisions. Why? Because they could always collude. Hmm? You know that word? Um, which is illegal. Obviously, it's illegal, but well, I mean, if they meet secretly and discuss and say, well, we're not going to decrease our interest rates on home. If you don't do it, I'm not going to do it, and they commit, then it's a problem for customers, right? So you need competition. You need to have a lot of banks, and I know that in Vietnam you have a lot of banks, right? More than 20, I would say, in terms of not 30 type of banks. If you have the number, I would be happy, by the way. And I'm talking different banks, right? Different brands, different companies. I'm not talking about groups. Um, we have a competition law now, good, and hopefully it's doing good to market. More competition is better for customers usually. It's not very good for companies, obviously, but good companies they find ways to provide good products and make money in some other ways. You don't want to rely on being a monopoly or an oligopoly to make money. That's not good economics, right? So if there is no question, I'm going to move on. So banks' profitability is also a limit to excessive money creation, but it's endogenous. As a matter of fact, lending too much money translates into greater demand money by for base money by customers. That's the leakages we talked about yesterday or 2 days ago, and higher risk of defaults on loans, right? So it's yeah. So in terms, I'm going to move back to share notes. It's probably better if I write there. Um, and there are two sorts of limits to money creation. One comes from the central bank via the access to base money, right? Maybe the policy rate, maybe the reserve ratio requirement, and so on. Okay. And second, and this is exogenous in a sense that it is not up to the commercial banks to decide. There's some endogenous limit in a sense that they relate to um, the profitability of the commercial banks, and in particular, banks who do not want to lend money to people that businesses that are not able to pay back or are at high risk of not paying because then it would turn to a loss. So my point is, even though you have monetary policy that's sort of trying to control that process of money creation by playing with interest rates and the reserve ratio requirement. On top of that, and perhaps even before monetary policy, you have endogenous limits to money creation. Banks are not going to lend as much money as possible. They're just going to try to lend money in a way that guarantees that they're going to be earning an income on that. Okay, they're not going to lend money to a homeless person, in the street who has no income or whatever, right? And they try to lend money to people that can pay back. I told you about this French saying we have that. I'm going to say it in French. Pretty much means banks lend only to rich people. That's a bit of an exaggeration, right? But that's what sayings are about. Okay, it's about exaggerating things. But the reason I'm saying this is to emphasize that banks are reasonable. They're gonna make the most for themselves. They're gonna try to optimize their lending policy. Okay. So as a matter of fact, lending too much money translates into a greater demand for. So yeah, banks' profitability is a limit, all right? Because if you lend too much money, that means a higher demand for base money and also higher risk on default on loans. Because typically you're going to start lending to the very good customers, then to the good customers, then to the average customers, and you should stop, right? You should stop at the average customers. You don't want to go below. But if you want to lend more, you're going to have to lend to the less than average customer, then the bad customers, and then the very bad customers. But on these guys, you're going to lose money, right? Typically, you're not going to do that. But important, the bottom line is important, and I'm going to highlight this. There are exogenous and endogenous limits to money creation. All right? Let's move on. Making too many loans reduces the bank's profitability. Yes, that's what we've discussed, because if you go below some sort of threshold, and we talked about credit scoring, credit score. Credit score. I'm going to ask you this now. Is there any one of you here because you all guys are working in the banking industry, I think. Is anyone familiar or working on credit scores? Customers? Yeah, you are. So you know what that is. My credit score is about pretty much putting a number on customers. Okay, and the higher, the better. I'm simplifying things obviously here, but that's what it is. So it's a score. So you add different components like the income, health, life expectations, assets, and you put some weight in front of that, and you get a number, and that's a credit score. And the higher the score, the better the customer usually, and then banks are happy to lend. Okay. Borrower rating and credit appraisal. Yes, that's what I mean. Yeah, credit score, credit ratings, credit appraisal. Yes, that's another way of saying it. In the US, the credit score is public information. Apparently, oh, that would be embarrassing. I'm sure that's not the case in Vietnam, but in the US, it is apparently. So you can Google the credit score of your neighbor. That's crazy. This is I love the US, but it's a crazy country. One is typing, so I'm going to wait for the question or the comment to show up. Moody's, yes. Moody's and Standard & Poor's, those are rating agencies. And that's not exactly the same, because this guy, Moody's, Standard & Poor's, they are rating companies. They are rating governments, whether those governments or those companies uh, have the ability to pay back or not. Here I'm talking about commercial banks rating their customers. It's the same idea. I agree, it's the same idea. But Moody's and Standard and Poor's are not rating customers. They're not rating households like you and me, right? They're rating governments and big firms. Here I'm talking about commercial banks, Vietcombank, Vietinbanks, who are calculating credit scores or credit ratings or credit appraisals for the customers. I have a comment here. In my bank, we are trying moving from credit scorecard to modeling credit risk. Yes, that's interesting. There are various different ways of doing that, and there are always new ways of more sophisticated ways. So it's usually pretty interesting. So there's another comment coming, so I'm going to wait for that comment. Yeah, but you need to distinguish between credit rating agencies like Moody's and Standard and Poor's, again, which are rating big firms and governments, and credit rating within banks for the customers. It's different. In my bank, the credit scores are based on some criteria. Okay, well, you can use, obviously, you can use the same as Moody's and Standard and Poor's. You do your own cooking, as they say. Okay, every bank is going to have its own formula. Uh, they have can follow some standards and some rules provided by those big rating agencies. Yeah. Okay. So second thing that I want to emphasize. So I just say making too many loans is can be bad because you start going into customers that are not very that have a poor credit rating, right? But making too few loans is not good business either, because assume you're a bank, right? And every time a customer comes to see you and asks for a loan, you say no, a big fat no. If you do that again and again and again, then soon enough your bank will have a reputation of uh, being very risk averse, right? Being very cautious, too cautious, and when probably the customers will say, well, this bank is not very keen on lending money, so perhaps I'm going to go and see a different bank, a bank that perhaps will look at my loan demand and say yes. You see, so if you're a bank and you keep saying no, even to the good customers, you're going to be losing money. So it's actually a fine line for a bank. Okay, it's a fine line. Okay, you have to make sure that you lend to the good customers, but not too much. But you don't want to be lending too little as well, because if you're lending too little, then you're losing profit opportunity. If you lend too little, you are losing profit opportunities. Okay, that's a fine line. To summarize, the limits to money creation are monetary policy via the cost of base money, and as I said, this is exogenous. And second, there's the bank's profitability, which is endogenous, and which we just discussed. The fact that if you lend too much money, this is going to translate into greater demand for base money and a higher risk of default. Okay. So I have a question for you. How come private banks create their? Oh, it's not really a question. It's a rhetorical question. I'm going to answer it. How come private banks create their own private money? By law, they can, and you cannot. You cannot create your own money. You can try to do that, but good luck. I'm sure people, unfortunately, people will not be happy to be paid with your own money, right? Only banks can do that because they have a banking license, right? This is called a banking license. Okay. By law, banks can monetize loans and foreign currencies. They earn an interest on every dollar they lend out, on credit cards, home loans, overdrafts, and so on. When a loan is paid off, private money is destroyed. This process is at the heart of modern capitalism. Okay? Oh, that's a joke. I like it. Short game. One player is named Banker. He wins. I think that's funny because that's exactly what it is, right? It's good to be a banker. So I guess you guys choose the right industry. You're smart. Hmm? If you are here today, it means you're smart. Why not be closer to the people who are creating the money? Huh? Okay, question number two. What control, again, it's a summary question. What control do reserve banks have on this process? Well, the central bank can make it more or less costly for private banks to create their own money. How? By increasing or decreasing the cost of base money for private banks. That's the interest rate. But this control is only indirect, since the final decision whether to borrow money or not is taken by agents, not by the central bank. By the way, sometimes I say central bank, sometimes I say reserve banks, that's the same. It's the same. Yes, that's something we have not talked too much about it, so it's worth spending a couple of minutes on it. This control by the central bank is only indirect. Why is that? Because even if you raise interest rates as a central bank, obviously commercial banks are going to pass on this cost. That word because it's important to pass on. Commercial banks are going to pass on this cost. So that means it's going to be more expensive for customers if they want to borrow money. But if for whatever reason this higher interest rate does not change the customer's decision to borrow money, then your monetary policy decision is going to have no impact, right? No effect. And I'm going to give you an example here. It's Australia in the late 2000s. So I told you I lived in Australia and I arrived there in 2000, I think 2008 or something like that. And the central bank was right, that was just before the crisis, the 2008 crisis. That's the Reserve Bank of Australia. It's called the RBA, the Reserve Bank of Australia. Was raising interest rate because that's before the 2008 crisis again. The economy was doing so well. The economy was very strong. The central bank was afraid that there was too much credit being created, so they wanted to cool down the economy by raising interest rate. But Australian households were so optimistic, they were doing so well, the economy was doing so well, incomes were rising fast, house prices, apartment prices were rising fast. People were not really impressed or influenced by the central bank's decision of raising interest rate. They were still happy borrowing money, even if the cost was moving up, moving up, moving up. So the reason I'm saying this is to really emphasize the fact that this control over the money supply is really only indirect. It's imperfect. It's not sure it's going to work, right? You're not sure it's going to work because if the people are happy borrowing money, even if it's very expensive, they're going to keep doing it. Okay, and the best example for that is Australia right before the crisis. I mean, we're talking about borrowing money on a 2-year horizon, 10% interest rate, right? So by European standards, it's very high. It's extremely high. Yeah, 2-year loan in France, the interest rate will be less than 1%. It's insane. It's really bad, but that's the way it is. Another example is the other side of the coin is Europe. Perhaps not a couple of years ago, but Europe after, let's rather say that Europe a couple of years after the 2008 crisis. draw that. So then it was the opposite situation to Australia. The idea was to drop interest rate. You remember, like a few slides I'm talking about. You can see that interest rates in Europe were very small. Okay, uh, nearly zero. That's the green line. But that didn't have much of an impact on European household decision whether to borrow money or not. Because there was the opposite to Australia. They were very pessimistic. Right? The crisis had hit. Some people were losing their jobs. The housing market was going down. The media was talking about the new great financial crisis. They were scaring everybody. So interest rates were very low. Even even though interest rates were very low, people were not taking advantage of this very low interest rate environment. Okay, why? Precisely because even if money was very cheap to borrow, they didn't want to borrow any money because they were afraid they would not be able to pay it back because they might lose their job, they might lose their house, and whatever. Okay, so again, I'm gonna emphasize that this control by the central bank is only indirect. It doesn't always work. It depends on households and businesses' expectation, right? Okay. Two questions. So why do you think your banker is always smiling when you come to make a deposit? So that's my question to you. But think technically, right? Uh, Take into account what we've done over the last few classes. Why do you think they're happy when you come and make a cash deposit? Multiple users are typing, so I'm waiting for the answers. Money deposit means the bank will have more base money, they can give more loan and have more benefits. That's very good. That's, I would say, 80%, no, 60% of the answers. That's something more I wanted you to say. Generate base money. Yes, that's the best. So, Nobel Prize of the day for Mrs. Try to pronounce your name. I'm sorry. I'm very bad at this. Nobel Prize of the day for Mrs. Oh, sorry. That's only to me. Sorry, one person. Okay, for Mrs. Yes, because that's exactly right. Because the answer is the following. I'm going to write it on the slide and I put that you because you are bringing base money for free. Okay. Usually, commercial banks have to pay an interest rate to access base money. Okay. And you are bringing free, right? That's why bankers are so happy when you come and make a cash deposit because cash is base money, but you're bringing it for free. And we know, you know now that for commercial banks to access base money, they can borrow from the central bank on the interbank market, but when it's cash, it's going to be from the central bank, and they're going to have to pay for that. They're going to have to pay an interest, right? So that's why. That's why. So that's why when you say generate base money without interest rate, that's the correct answer. Let me see what other people answer, because if customers make more deposit, but we have more base money to make on. That's also true. That's also true. But that's also true. But I like the idea that you're bringing it for free. Okay. All right. Next question. Why do banks ask to be informed a couple of days ahead for large cash withdrawal? Again, I'm asking you this. Why do you think they do that? I can see that you're typing, so I'm going to be waiting for the answers. But we need to pay interest rate for term deposit, right? We need to pay interest rate from term deposits. Yeah, that's right. Here I was just assuming, maybe I should have been more specific. Maybe I'm just assuming you put it in on your account just like that. They need to negotiate and arrange base money from interbank market. Yes, exactly. So the answer to the second question is the following. Uh, why do banks ask to be informed about? Because commercial banks always try to minimize the amount of cash they hold in their vault, because cash is not an income earning asset, right? Securities are paying incomes like dividends, interest coupons, etc. But cash based money is not paying anything. Base money is not paying anything. Indeed, it has, in addition, it has an opportunity cost, right? Because it could be invested into some securities instead. Right? So that's why. That's why. One option for the bank would be holding a very, very large amount of cash so that they never face any problems when people ask for cash. But that would not be optimal from a cash management point of view, right? That would not be profit maximizing, because this cash is not earning any income. It's a dead asset in a sense. So they always try to minimize the amount of cash that they hold to make sure that they can satisfy day-to-day business demand and household demand, but they will not hold more than that. Okay, that's why. That's why. Okay. All right. So yeah. So here's the exercise. So do you guys have any question on what we just did before we do the exercise? Okay. Looks like there's no question. So I'm gonna go to the exercise. So exercise 6. So we have a central bank and a commercial bank with the following simplified balance sheet. So this is something that I've added to the slides, right? I don't think you have it in the slide um, that I have given to you. So I think I might upload that on the Canvas platform at some point, but you can look at it now otherwise. But it's a new exercise um, which takes into account um, the question that was asked by one of you yesterday. Do you remember someone was asking about how to uh, take into account within the central bank's balance sheet if the central bank is issuing a bond? So this is the first question. So take a central bank and a commercial bank with the following simplified balance sheet. So there you go. So you have reserves, loans, securities for the commercial bank. And for the central bank, you have securities and base money, which we have divided into cash and deposit by commercial banks. Okay, very standard. First question, assume the central bank issues a 10,000 bond and sells it to a commercial bank, represent the commercial bank and the central bank's balance sheets. Okay, so we're talking about a bond being issued by the central bank. Okay, it's not a bond issued by some other company, right? It's issued by the central bank. Question number two, now we're talking about the central bank and the government. Assume the central bank buys a 10,000 worth of government bonds from a commercial bank. Represent the new central bank's balance sheet only. And assume now that the central bank lends directly those 10Ks to the government rather than buying a bond from the government and represent the new central bank's balance sheet. Okay, so there are three questions in this exercise. I think I'm going to give you 10 minutes again to do it. But before I part you into those breakout rooms, I want to make sure that you guys understand the exercise. So is it clear? Or do you have any question on the exercise? Right, so you're going to have to record what's happening when the central bank issues a bond, when the central bank buys bonds from the government, and when the central bank lends directly to the government. Okay, so it looks like there's no questions, so I'm going to create those shared rooms. Perhaps I'm going to give a bit more time, like 11 minutes, because I want you to think hard about this stuff. Okay, so breakout rooms. I'm going to allocate you randomly again. 11 minutes, randomly assigned. Okay, let's go. All right. Welcome back, everyone. So uh, let's start head on. And who wants to answer question one? So in question one, we have the central bank that issues a $10,000 bond and sells it to a commercial bank, right? So I want you to register the impact on the central bank's balance sheet and the commercial bank's balance sheet. Okay, we don't have that many candidates, so I think I'm gonna answer it. You don't want to try? It's usually interesting for me to see what sort of answers you provide. Some when they are good, obviously, but also when they're not good, because it's very interesting. So good. I can see that some of you are typing. So waiting for the answers to show up. Alors, for the central bank, we have securities minus 10K and base money minus 10K. I'm afraid not. Um, I don't think this is correct. Not because the central bank bond is not an asset for the central bank. Okay. Let me see the other answers. Central bank security plus 10, commercial bank plus 10, base money plus 10. That's good. That's good. So this is Mr. Tran. The answer is good, at least for the commercial bank. For the central bank base money plus 10 securities, no, 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 no. Securities will not be impacted for the central bank here, actually. Next answer, central bank base money plus 10, securities minus 10, yes. Central bank security, no. No movement on the securities here. Tac, 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 tac. Central bank asset. No. Okay, I'm going to provide the answer. Thank you for participating. I really appreciate it. It's not always easy in front of everyone to try and answer, especially if you're not sure of the answer. So the thing is, so I'm going to start with the commercial bank because I think um, you 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 provided a correct answer, right? So we have the central bank that issues a 10K bond and sells it to a commercial bank. So the commercial bank will buy it. So we're going to have plus 10K for the securities, right? Because it's for the commercial bank, it is a security. Okay. Yes. Oh, that's very good. I think we have a good answer. The last one, central bank liabilities, base money minus 10, and central bank bond plus 10. That's excellent. I think you already, that's very good. I'm going to copy it. Okay. So let me for keep going. So the security. So if we go back to the commercial bank, Let's do it very slowly, step by step. The commercial bank, it's easier to address, right? It's buying the security that's been issued by the central bank. So it goes into the big pool of securities on its asset side. And how does it buy it? Well, it buy it by spending some of that, some of its reserves. So we're gonna have minus 10. Okay. Okay. So if we draw a line now, here, up, up, we have the reserves have fallen to 30K, right? And the securities have increased to 110K. So there is no change on the size of the commercial bank's balance sheet. It's just a change in the composition of its assets, right? A bit less reserves, a bit more securities. The interesting part here is what's going on for the central bank. So most of you answer that it's going to change the security, the asset side. No, it's not. Why? First of all, you have to remember what is a securities from a central bank's point of view. It's an asset, a financial asset that the central bank has bought on financial markets, on the money market, right, on the interbank market. So it can be bonds, it's mostly going to be bonds, but it can be stocks, sort of something that's paying an interest, right? Some sort of revenue to the central bank. But that's not what we're talking about here. Read the question one. Assume the central bank issues a 10K bond and sells it to a commercial bank. So it's the central bank that is issuing a bond. So it is borrowing money. That's what it means when you issue a bond, you're borrowing money. So because a you're asking someone to lend you money, it is a liability. Okay? So what we're gonna have actually is we're gonna have this central bank bond that's gonna appear here. It's gonna show up on its liability side, central bank bond. Right? You're gonna have it's a it's someone is lending money to the central bank. Okay? And how is this and who subscribes to this bond? Well, one of the bank, right? So we're gonna have minus 10K for the deposits by the commercial banks, right? Because this particular that's what you have here. Look, I'm gonna up up minus 10K here. They're right here. Okay. That commercial bank has spent money, has purchased the central bank bond. So its account, the amount of reserves, its reserves decreases, and it decreases on the liability side of the central bank as well. Okay. So I'm going to draw a line now to compute the net. All right. So we have now 690 90K for the deposit by commercial banks. Okay. And so obviously we have minus 10K plus 10K. So there is no change in the composition of the liability. There is no change in the size of the central bank's balance sheet. It's just a change in the composition. Okay. So this is important to understand, at least for the mechanics of the bank's balance sheet. Okay. Because it is a bond issued by the central bank, this means that the central bank is borrowing money, right? In the sense, that's what it means. So it has to show up on the liability side of the central bank. And so another way to look at it is just to say, well, the central bank can issue money or it can issue bonds. But in both instances, it is some sort of a debt that is being issued by the central bank, either in the form of base money or in the form of a bond, right? But it's a debt in both cases, right? So I'm very glad I insisted that you provided me an answer, you see, because I could see that many of you actually uh, were not clear about the security. So again, the thing to understand is that the securities for any legal entity, whether it's a central bank or commercial bank, is an asset that you purchase from someone else. When you're issuing a bond, it's not an asset. Okay, you're issuing a liability. It's going to be an asset for someone else. It is an asset now. This bond is an asset for the commercial bank. That's why it shows up on its asset side, right? But it's a liability for you. Usually, when you have a liability showing up somewhere, you have an asset showing up somewhere else. Okay, that's and vice versa. Okay, so I'm happy to take question here because oh, let me oh, is it clear? Okay, good. Good. So yeah, good. It's a good mistake, right? This is a sort of mistakes you are learning from. So if there is no question, I'm going to clear this balance sheet so that we can answer question two. All right. So question two, assume the central bank buys 10,000 worth of government bonds from a central bank, represent the new central bank's balance sheet only. So please answer if you have an answer to suggest. So the central bank is buying a bond issued by the government, and this time it's by the treasury, right? The central bank will not buy its own bonds. So again, the central bank is buying some government bonds from commercial banks. How is the central bank's balance sheet impacted? Central bank assets securities plus 10, yes. Liabilities base money plus 10, yes, that's good. That's good. I would be a bit more specific here by making it clear that it is securities, but it's government bonds. So, but I guess you're right. So I'm going to put plus 10. Okay. Okay. And because it's buying it from a commercial bank, then there's some commercial bank's account that's being credited. Okay. So now we have some bond for specific. Yes, we're gonna put that here. Okay. It's a subcategory of securities. So now we can make the subtotals. All right. And the total asset has changed, so we're gonna cross that out. And I'm gonna cross that out as well. And we're gonna write the correct total here. So we're gonna have 1.01 million 710 Ks for the deposit by commercial bank and 1.01 million. Oops. And 1.01 million. Oh, what's wrong with you? The slides. Oh, I cannot shift. I cannot zoom out. Uh, what seems to be the problem here? Yep, that's better. Okay. All clear for this one? Pretty easy. Okay, so question number three, assume the central bank lends 10 Ks to the government and this time I'm asking again to represent the central bank's balance sheet only. Okay, so who wants to answer that one? Central bank liability government bond plus 10K. Base money minus 10K. I'm not too happy with this answer. I'm not too happy. So here we have the government that we have the central bank that's lending money to the government, right? So as soon as you hear about the central bank lending, that means that the base money has to increase, right? So I like that answer. That part, base money plus 10K, loan, yes. I think that's better. Thank you. This is correct, okay? So it's a loan. So it's not really a security. So I'm going to create a category here. I'm going to take loan, right? Loan government. Why? Uh, because it's not really a security, right? So, okay. And you can have, how about this? Okay, deposit by government. I like this. We're gonna have plus 10K. Because here we only had deposit by commercial bank, but assuming the government can have a deposit at the central bank, that's the way it would work, okay? So that means we have a new grand total of 1.01 million. 1.01. Right? Yes, that's the way it is. Okay. So the point I would like to make at this stage is the fact that, as you can see, that it's a dangerous path. Put that here. Why is that? Because you can see that where do we stop, right? Uh, there's a lot of money that's money that's being created here, but where do we stop, right? I mean, if you have like a very strong government who's not very keen on raising taxes or managing its finances wisely, which could just ask the central bank to print money, right? And the balance sheet would expand, 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 and that can be inflationary. Okay, so this sort of things now is forbidden in the West, for instance. Okay, or it's very, very tiny amounts, right? Okay, let's move on to the next slide. I want to show you before we end this class today some real commercial balance sheet. Okay, some of you may be familiar with it because you're working in the banking industry, for many of you, but it's always a good exercise. Okay, so this is a detailed look at the commercial bank's balance sheet. It's the real one, and we're talking millions of US dollars, right? So look at the asset side. If you the asset, I told you we have three main categories. We have the reserves, the loans, and the securities. Let's see what we have here. The reserves, right there. Some of it is cash, and the rest is deposit at the Fed, right? For a total of 59. The big part is the loan portfolio, right? Customer portfolio, business portfolio. And then finally, you have the securities, treasuries, and the federal funds. Okay, that's the sort of securities that this bank is holding. Okay, so you can see in terms of and the physical asset, what that would be the offices, right? The offices and all the real assets that are owned by the bank. Okay, in terms of proportion, you see that the big item here are loans. Okay, it's nearly 2,300 compared to 3,000, so it's by 80% of the portfolio of the asset side, right? And if you look now at the liabilities, I told you liabilities is mostly deposit. Well, it's all that we have here. Transaction deposit, other types of deposit, including savings accounts, certificate of deposit, other deposits. So those are all like savings account, right? So savings account. This is the CASA. The first one would be CASA, what you call CASA in Vietnam. And other liabilities, other bank loans. So that would be a loan by another bank to this bank. And that would be a loan from the Fed. Okay, and the net worth. I told you the difference. The net worth is the difference between all assets and liabilities. It's an equity, if you want. Okay, so that's a typical commercial balance sheet. So as I told you, we have those three categories on the asset side: loans, reserves, securities, and on the liability side, it's pretty much only deposits. Okay. Let's have a look now at a central bank's balance sheet. So we're going to start with the Fed. I hope you guys can see clearly. So the Fed balance, I told you a central bank balance sheet is very simple. There are only two things. I'm going to clear that out. You have securities on the asset side and base money on the liability side. Base money being composed of two things, cash and deposit by commercial bank. So let's see if that's what we have for the Fed. All right, so in terms of the asset side, where are the securities? Oh, securities held outright. We're talking 4,226 billion. That's 4 trillions out of a grand total for assets or 4.4 trillion. So it's 4.2 trillion out of 4.4 trillion. So yeah, I think we are correct here. Almost anything on the asset side of the Fed is securities. You have securities, U.S. Treasury securities, those are the T-bonds, the federal agency debt securities, mortgage-backed securities. We're going to talk a lot about that tomorrow, those MBS. This is the Fed balance sheet, perhaps around 2009 or 10, right? It was right after the great financial crisis when the Fed has to buy back all those mortgage-backed securities from the commercial banks to remove them from their balance sheet because otherwise the bank would just go bust. So we're going to talk extensively about that tomorrow using all the knowledge we have accumulated so far in terms of balance sheets and so on. So yeah, I can already tell you what we're going to do tomorrow. Tomorrow we're going to use everything we've done. We're going to finish this section 3 because section 2 because I still want to talk about sterilization operation and lender of last resort, but it's going to take us perhaps half an hour. The other 2 hours will be dedicated talking about the great financial crisis and Euro crisis, but especially the great financial crisis, using everything we've done so far. So we're going to look at it with the Fed balance sheet and so on. You're going to see it makes a lot of sense. So securities, overnight securities, lending, and so on. So you can see it's mostly securities, right? Oh, that's some foreign currency. Okay. This is going to be big for the Chinese central bank. The People's Bank of China. That's how we call the central bank in China. People's Bank of China. We're going to look at the People's Bank of China tomorrow. My point is this item is going to be much bigger in proportion for the central bank in China. So that's for the assets. So we've seen it's mainly securities, a bit of foreign exchange, right? What about the liability side? I told you the liability side is going to be base money. So we have a grand total of 4.4 trillion. Oh, those are the notes in circulation. So this is the cash, right? It's 1.4 trillion. And so this is the cash. And those are the deposits by commercial banks at the central bank, which they called other deposits by depository institutions. So if you add this and this, you're pretty much very close to this, right? That's some other stuff like reversed repurchase agreements. We'll maybe talking about it tomorrow. Those are just monetary policy instruments, right? We should have also the bonds issued by the central bank showing up here. Oh, look, that's interesting. We have the US Treasury account. So if you move back to exercise, this is, I've cleaned that up unfortunately, but this is for, you see, when we were doing this, the government account was showing up right there. So it's here. So that's 300 billion. That's not negligible. So I'm trying to find if there is any bonds issued by the Fed here. Term deposits, other deposits, foreign official international accounts, others. No, that's that's so notes, repos, foreign official international accounts, others, term deposits, other deposits. No, it's not showing up, or maybe it's agglomerated somewhere. Anyway, let's have a look at the. Ah, that's interesting. Oh, I'm over time. Sorry. Let me see where we stand. Oh, we're pretty much done. But yeah, perhaps I'm going to finish with this slide, and then I'm going to briefly, and then I'm going to take a couple of questions. So this is the Fed's assets. This is the Fed's liabilities, right? So we're talking about looking at this side, how it changed, and then this side, okay? So this is the great financial crisis in 2008, okay? If you look at the asset side first, well, actually, there were a lot of money that was being injected right after, right at the beginning of the crisis. That's this part. And then that was like emergency liquidity provided to the commercial banks. Okay. But immediately after that, the central bank engaged in those QE, quantitative easing. Quantitative easing was basically very big open market operations. So that means they were purchasing assets like US Treasuries and also mortgage-backed securities. Okay, so they purchased the mortgage-backed securities, QE1, then QE2, then QE3. Okay, so that's why the Fed balance sheet exploded. I mean, look at that. I mean, the total asset was less than 1 trillion, and then it, in a matter of a few years, moved up to 4 trillion. And obviously, this translated by a lot of base money being generated. A big spike right at the beginning of the crisis, and the QEs and so on. Okay, this is just base money being created, mostly in the form of commercial banks deposit at the central bank. Okay, so I guess I'm going to finish here. I'm sorry I went over time. I'm happy to take questions. If you do have questions, otherwise we're gonna reconvene tomorrow, and I'm gonna summarize all this, do the sterilization stuff, and then we're gonna talk about the great financial crisis tomorrow. But at this stage, I'm happy to take questions if you do have questions. Why the liquidity reduced from 2009 from Fed assets? Good point. The story is the following. At the very beginning of the great financial crisis, the Fed didn't have the time to organize big open market operations. So the immediate reaction was to throw liquidity in the system through the discount window, right? liquidity facilities. So you remember I told you there are two ways of getting base money: either the discount window or open market operation. But open market operation, they are not that straightforward to organize, right? You need to identify the asset you want to buy. You need to organize an asset purchasing program. You probably need to pass this into law as well. So it takes time. And that's why we had three QE, three quantitative easing. So that's why at the very beginning of the crisis, they could not do that. So they could not act on the blue line. But what they could do is provide liquidity through the discount window. And that's exactly what they did, right? So that's why you have this big spike in the red line, which are pretty much which corresponds to liquidity providing operations through the discount window, right? And those were loans, by the way. Okay, those were loans. So it's not, you see, loans to commercial bank. That is why it is an asset. Okay. That's and if you look back into the Fed balance sheet, that would be, yes, lending to depository. Oops, that would be here, I suppose. I think that would be here. Okay, you're lending money to the commercial bank. So you big spike in liquidity, and then little by little, the Fed shifted, removing some of that liquidity, so it went back down. But at the same time, you could see they were purchasing massive amounts of assets, treasuries, and especially mortgage-backed securities, which we're going to talk about tomorrow. Okay, so that's why it was a two-phase reaction. The emergency reaction was loans to commercial bank. Yes, here is the liquidity. I provide you as much liquidity as you want through the discount window. Then this gave them time to organize QE1, the first big, massive open market operation. And then they phased out the liquidity facilities, and then they jump up the QE1 and then QE2. All right. No, you're welcome. Any other question? Okay. It looks like there won't be any additional question for today. So it's time for me then to thank you for your attention. Thank you for the participation. I very much appreciate it again. I think it makes the class lively. It's very nice. I'm surprised that you are not so much involved. So I like it. Keep the good work, and I see you tomorrow.